This is a weekly prep, and I'm about to go over my premiums and my discounts on the dollar, the NQ, and the ES. So let's get it started. First, I'm gonna start off here on the dollar. My drawn liquidity for the dollar is right here. Underneath these prices right here. This candle, the low on this candle is 97,921. So the reason why that's my drawn liquidity is because if you go down to the weekly time frame, right, the market drew into a premium, which is this fair value gap right here. Prices, the high on that candle is 102.76. The low is 101.267. These were premium prices, and for the first 2 weeks of the month, this candle and that candle, the market drew into the premium. And if you know anything about smart money, that's what smart money does. The smart money sells from the highest prices that they can, which are premium prices. And on the inversely, right, on the exact opposite side, smart money buys the market from the cheapest or the most discounted prices that they can. So let's flip that into like, yo, if you're trying to buy an iPhone, right? If you want to buy an iPhone or buy the market, right? When you buy your iPhone, you want to buy it for as cheap as you can get it for. So as cheap as you can get it for is a discount. And if you're selling an iPhone, right, you got an iPhone, you need to, some extra money because you got to do this, do that, whatever you got to do, right? You want to sell it for as much as you could get it for, which is a premium, right? So if you're selling the market, you want to sell the market from a premium. These prices right here were the premium prices for the month. That's why for the first 2 weeks of the month, the market was being bought. And if you go up to the monthly time frame, right, the market opened at this price at 99,654, right? In the very beginning of the month, for the first 2 weeks, this was a big green candle. Look at the wick. It was a big green candle because the market was being bought into the premium prices. And smart money already got in their positions. And long story short, the third week, which was last week, the market opened up and sold off hard. So I'm gonna go down here. I'm gonna look at this real quick, and then we're gonna go to the ES. When the market opened up last Sunday, right? The market opened up in a gap. See that gap? Nobody was able to buy or sell the market in between those prices, right? And there was a reason for that. The reason is more or less because the market is in a rush to get to where? The discounted prices. Where are the discounted prices? Underneath here. This is the drawn liquidity for me right now. So this week, I'm looking to go short on the dollar. And like I was saying, if you want to go short on the dollar, right? If you want to go short at all, it doesn't matter where you're going short at. You want to go short from the highest prices that you can go short on. So the closest prices that is like the most reasonable for the premium are these prices right here. I didn't mark them out, but those prices right there. This is a fair value gap on the 4 hour, right? These are the closest premium prices to the market. You never want to go lower than the 4 hour, but those are the first ones. And the deepest premiums are these prices up here. The market may not get up there, and it doesn't matter if it gets up there or not, but the bigger picture to it is the market is being drawn toward these monthly discounted prices. So if you switch over here to the futures, the ES, right? If you're going short on the dollar, you should be going long on the futures. It's an inverse relationship. So basically, you start off on the weekly. If you want to, like I said, if you want to buy the market, you want to buy the market for at the most lowest price you can buy the market at. Same way, if you want to buy an iPhone, or if you want to buy a used PS5 or something, you want to buy it for the cheapest you could get it for. So the discounted prices are right down here, right? Go down to the daily time frame, actually. So on the daily time frame, there's a big volume imbalance down here. So once again, as we seen on the dollar, there were prices that nobody was allowed to buy or sell the market. So in between these prices right here, there's not even a wick in between those prices. And the reason is because the market just basically said nobody is buying or selling any of these prices. We're leaving those there for another day, or for basically for smart money, to accumulate orders. So a lot of smart money is going to get in the market down here, and they're going to be buying up these orders at these prices. So if you want to buy the market this week for the futures, right, you want to be buying the market underneath the price. But for the ES, underneath these prices, well, first, this 4-hour candle right here, you want to buy the market underneath there. Until then, you absolutely can sell the market. You can sell the market into the discounted prices. If you know what you're doing, you can sell the market into the discounted prices, because this is like basically the drawn liquidity right now. This is where the market is being drawn toward, right? So my premium prices are up here in the form of a daily fair value gap. It probably won't reach these prices this week, but this is where, after we get down here and get into these discounted prices, after we get down here, the drawn liquidity is going to be up here, and basically the market is going to be looking to trade higher. So I wanted to show you something on the NQ real quick, and then I'm gonna close this video out. The NQ, I don't trade the NQ. I only use the NQ as like to find a cracking correlation with the DXY. The DXY is my main quote asset, right? So I use the inverse relationship, right, with the dollar to figure out what I want to do with the ES. Now, in a perfectly symmetrical market, when everything is working the same way, when the dollar is making lower lows and lower highs, the future contracts, the ES and the NQ, should be making higher lows and higher highs, right? So the DXY should be making lower lows and lower highs. The ES and the NQ should be making higher lows and higher highs. So long story short, the NQ has a real big volume imbalance right here on the weekly time frame. This is how you know this is the drawn liquidity right now for this week coming up. The drawn liquidity is absolutely underneath the market price, because on the weekly time frame, there's a volume imbalance on the NQ. But guess what? If you go to the weekly time frame on the ES, there's a volume imbalance, but it's not like the same kind of volume imbalance. See why? Because there's wicks in between those prices. But if you drop down to the daily, there's a volume imbalance. In the 4-hour, it's an even bigger volume imbalance. So that's my drawn liquidity. I'm going long on the futures. I'm going short on the dollar. And if you know what you're doing, you can short the market into the discounted prices, and for the futures, and the exact same thing for the dollar. You can go long into the premium prices, but just I would just stick to the higher time frame. But yeah, that's my weekly prep for this week coming up. This week coming up Sunday the 25th, ending Friday the 30th of May. So yeah, like and subscribe. I'll make another video next week.